CNBC TV 18, celebrating 70 years of business leadership.
It is the second rate decision by the Monetary Policy Committee and the first big surprise. Good evening. Welcome to this special show. I'm Lata Venkatesh. All 6 members of the Monetary Policy Committee, the MPC, have voted to keep key lending rates unchanged against market expectations of a rate cut of at least 25 basis points. However, in a move that gives some respite to banks, the incremental cash reserve ratio requirement of 100% on deposits from September 16 to November 11th has been withdrawn from the 10th of this month, that is from Saturday. Not just that, the Reserve Bank has slashed its growth forecast for this financial year from 7.6 earlier to just 7.1. Not as bad as some of the scaremongers. The central bank also admitted that nearly 12 lakh crore rupees is back in the banking system as deposits after demonetization. The Reserve Bank also revealed that new notes worth about 4 lakh crore rupees have been minted so far and sent to banks. Any special dividend to the centre from the Reserve Bank was ruled out, and the central bank said that liabilities of the Reserve Bank will have to be maintained almost forever, or so it seemed. The Reserve Bank also defended the note ban, saying the decision was not taken in haste, and it also appealed to the public not to hoard cash because enough is being minted and sent. On this special broadcast, we will bring you an exclusive conversation with the head of the largest bank in India, Arundhati Bhattacharya of State Bank of India, later on in the show. Also joining us in the discussion, first up, is the former Chief Economic Advisor and a former member of the Monetary Policy Advisory Committee, Dr. Arvind Virmani. We will also be joined in a bit by V. Srinivasan, Deputy Managing Director of Axis Bank, Jahangir Aziz, the economist from JP Morgan, Anant Narayan, the Managing Director from Standard Chartered Bank. And right now we have already with us Ashish Parthasarathy, the head of Treasury at HDFC Bank. In a bit, Neeraj Gamir of Nomura will also join us. Well, for the moment, Ashish, welcome. We also have Dr. Virmani with us. Dr. Virmani, good evening and thank you very much for joining us, sir. Before I toss to you, maybe I want you to hear what Dr. Patel said on inflation, because that is a reaction which kind of surprised the market, not lowering the inflation forecast for March to 31 and therefore not giving a rate cut. Let's hear out the governor.
Inflation outcomes in September and October, as well as the latest projections for Q4 2016-17, vindicates this stance. It may be recalled that in October, the MPC envisaged a trajectory taking headline inflation towards 5% by March 2017, with risks tilted to the upside. Since then, a couple of risks have waned. The committee felt that it is now important to ensure that the targets of 5% for Q4 of 2016-17 and of 4 plus or minus 2% for the medium term are achieved. This assumes critical importance in view of the stickiness in inflation, excluding food and fuel.
Oh, well, actually, those were the more crucial lines. In view of the stickiness in inflation, barring food and fuel, in fact, in the statement, they also go on to say that some elements of food prices are also exhibiting sustained firmness. And the third one is, of course, the volatility in crude prices. Moreover, volatility in crude prices and the surge in financial market turbulence could put inflation target for Q4 at some risk. Dr. Virmani, would you agree with the assessment of risks to inflation and the monetary policy decision?
Well, I have disagreed with the inflation forecast from the last meeting that I attended of the advisory committee, which was in March. And I had gone on record in my blog to say that at the end of March, the CPI inflation rate would be between 4 and 5%. With, if I remember, 70% probability. And at no time during the year have I wavered on that forecast, and it's been on target and will be on target.
Okay.
So
okay,
there's
Dr.
no
Virmani,
question of agreeing with that.
Dr. Virmani, okay, I want you to assess the decision not to cut. That came as a shock, of course, to the market. To just argue on behalf of the Reserve Bank, right now there isn't so much demand for credit anyway because the nation is in the process of exchanging notes. They have time in February after they see the fiscal deficit number as well. Would so much be lost if they waited till February to assess inflation and then cut? How would you assess the rate decision?
So let me say a little bit about monetary policy. As I said, in March, again, the second point I made was that the Indian monetary policy, the international inflation targeting type of approach, which I have often called the New York-Chicago approach to monetary policy, is being Indianized by bringing in long-term liquidity into the picture. This is on my blog, so I'm not inventing it now. And to me, what seems to be my initial reaction is that this dual focus is coming in. The repo rate part of it, which is the standard global type of approach, is being in some sense more factored towards the global side, whether it's the way global markets perceive it, whether it's the issue of rate rises by the Fed, whether it's the issue of commodity prices and so on. And the second part is the liquidity part, which really I think is much more important in the Indian context.
Yeah, absolutely.
So that's how I view.
Okay, I take your point, sir. Yeah. Actually, let me toss that to the banker then. Ashish, from a treasury man's point of view, you have not got the rate cut. As well, neutrality in liquidity is going to be maintained. The surplus is seen as transitory. How do you react? Shocked?
So, of course, the decision on the rate was very unexpected. The market clearly 25 basis points cut was given as taken as granted, and maybe a chance of a 50 basis point cut. So that's where the markets were. So obviously it is something which is not expected. Obviously it was some extent surprise, or for some it could be a shock. Liquidity framework hasn't changed. They've always said we will move to neutral liquidity, neutral liquidity stance, and surplus was always assumed to be transitory. I don't think there is any disconnect on that bit. Yeah, we will move to that. But of course, the rate is something which was of a surprise.
So do you expect transmission now? Because the load of CRR has anyway gone. It is only a one fortnight load, and it will be a few 10 crores for y'all. Maybe even, it will be a small number for y'all. Does the path clear for transmission now?
So 2 points. The number for across the banking system would be quite significant for everybody. I think that even the fortnight maintenance of that kind of CRR is large. Having said that, we've been seeing deposit rates coming down over the last few months, weeks, etc., etc. So obviously that gives an indication that yes, lending rates will come down, given that now we are in MCLR, which is a formula based on your cost of funds, etc.
Are you cutting on Jan 1st? Or whatever, next month?
See, again, I think every bank now has a date on which it announces MCLR. So our next date would be sometime first week of January. We have to wait till end of December to figure out what is the composition of our liabilities, what are the marginal rates, and figuring out where the number will stand. We have not computed that right now, so I can't say now whether what will be the outcome as of January.
Okay, I guess it will also depend on how much money is left behind. In a bit, we will also play out what what I think the Deputy Governor spoke in terms of withdrawal limits. That will be important. But actually, why don't we play out what the Governor said about the dividend? There was a widespread expectation that the Reserve Bank, if it does not get a certain amount of money back, old notes returned, it will be able to declare to that extent a dividend to the government. Let's just hear out what the Governor said. I thought he put paid to that hopes.
The withdrawal of legal tender characteristic status does not extinguish any of the RBI's balance sheets. and therefore there is no implication on the balance sheet as of now.
Okay, there is no implication as of now is what he said. I think we should play that bite again and play a longish bite. Dr. Virmani, what did you make of that? Fiscal largesse from the RBI should be ruled out in the current budget on Feb 1st?
So about a week ago, this is a legal issue, and about a week ago I read in the newspaper a lawyer who understood these things saying exactly what the governor has repeated, that the extinguishing of the legal tender characteristic of currency does not change or affect the balance sheet of the RBI. So given that, it's good that, I'm not surprised. I'm glad he's given this clarification, because too many people thought otherwise. So in my analysis, I've kind of already factored in this fact, and from the beginning I've never paid much attention to this issue of a windfall.
Okay.
I focused more on the price changes and the fiscal, which is the voluntary tax payments which are likely to arise.
Okay, then a final question, Dr. Virmani. What will spur growth now? The Reserve Bank has said only half a percentage point of GDP will go away this year, which means, I guess, about 1% for the second half. As well, they are not sounding like there is a series of rate cuts. Fiscal largesse, you are saying, is not very much. What are you expecting by way of rate cuts, and how do you see growth and inflation next year?
No, I am not saying I said no fiscal largesse through the monetary system, but I do expect higher tax collections, much higher because of directly this, independent of the GDP.
Okay.
So what do I expect on the GDP front? What I have said is that the effect of demonetization would be to reduce the growth rate by between 0.2 and 0.5% points. And the second factor, which has not been discussed anywhere as I see, which I also kind of had indicated in March but didn't kind of incorporate in my forecast, is that this deflation point, which I made across the world actually, even in Washington DC, that when there was a deflationary pressures in the economy, including the Indian, the GDP was somewhat, the real GDP got a little overestimated, and we will see the reverse of that in this year, which is that because the GDP deflator is now rising much faster, the real value of GDP may be a little lower than what I had anticipated. So to summarize, instead of, I had anticipated a 0.2 to 0.5% increase, that gets overcome by the this demonetization, and my 7.6 estimate would be adjusted downward by around 0.2% points because of this factor which I have just mentioned.
Fair point, sir. Thank you very much for joining us, Dr. Virmani. We are also joined by Mr. Srinivasan, the Deputy Managing Director at Axis Bank. Srini, well, first thoughts, what did you make of that fiscal statement? There were some people who thought the governor said there is no question of extinguishing of liabilities as of now. So some people are interpreting that probably there will be an amendment. But at the moment, what would you assume if you have to look at the budget for next year in terms of a fiscal boost?
I think you'll have to go by what the governor said, that there is no change in the composition of the RBI balance sheet as of now. And I think even if you look at the window which is open, even after December 30th, I think there's a opportunity to go to RBI and deposit currency. So I think the entire final number won't be frozen even possibly after December. Exact number won't be frozen even after December 31st. So I would think we have to assume, as far as this budget is concerned, or as far as fiscal year this year is concerned, there's nothing which is coming out of the RBI balance sheet.
Okay. Let me come to the meat of the issue as far as you as a banker are concerned. Would you take away positives? Your money is going to earn 5.75, no less, at least that. What have you taken away as a bank? Are you better off after the policy and the CRR rollback?
No, I think there will always be pluses and minuses. You can always argue that if yields were 20 basis points lower, what would be your treasury gains and what sort of book you have. Or you could argue that my CRR was earning me nothing. I'm getting 5.75 on the excess CRR, which I was maintaining. So I think that is very bank specific. On the whole, I think if we have to take RBI's judgment, what they're saying is the impact of demonetization is transitory and very short term, and they believe the fundamentals of the economy will play out shortly. And that should sort of instill some more confidence in terms of how exactly to plan in terms of both credit as well as in terms of growth, at least for the next financial year.
Oh, well, I'm not sure what certainties you got in terms of, how much money will be left back, because I thought one of the unanswered question was, when will the withdrawal limits go away? We'll do one thing. We'll take a break. And when we return from the break, we will play exactly that for you. What Mr. Gandhi said when he was directly asked, when will the limits go away? We are back in a minute with Ashish Parthasarathy, V. Srinivasan and more bankers.